In this part of the option trading course, we are going to take a look at the basics of put options. In the previous video, we have gone through the basics of call options, and you should be familiar with what they are and how they work. Otherwise, please go through that video again. The link is in the description below. I would like to say again that you should not be trading options without full knowledge and proper training, as they carry high risks and can blow up your account very easily. So what is a put option? A put option, likewise, is also a contract that gives the buyer, this time, the right to sell 100 shares of the underlying stock at a specific strike price at or before the expiration date. Using the same example of Apple, when you buy a put option on Apple through your broker, this is normally what you would see. In this condensed notation over here, you are buying one put contract of Apple shares, which is the underlying stock. And this put option contract controls 100 shares of Apple. This contract has an expiry date of 19 June 2020. The strike price is the agreed fixed price at which you will be selling your shares of Apple. And in our example, the agreed strike price is 300 per share. So what is the price for this put option contract that you are about to buy? It is stated in this last piece of information at $10. The $10 here means $10 per share. So you have to multiply it by 100 because this contract controls 100 shares of Apple. And so the full price of this put option contract is $1,000. When we went through call options, I gave an analogy that buying a call option is like paying a deposit for a house that you want to buy in the future. And you want to lock in the price of the house at the stated strike price. So what about the put option? You can think of buying a put option like buying an insurance for your stocks. Insuring your stocks for what? For the event that your stock price suddenly plummet. Let's say that Apple is currently trading at 300 per share right now, and Apple is about to report earnings, and that you are afraid that the price of Apple will crash if they miss expectation or announce poor guidance. So therefore, you bought this put option contract to secure yourself at a price of $300 per share. Just like having to pay the premium when you purchase an insurance policy, you also have to pay a premium as the put buyer. In this case, the premium paid is the price of the put option contract, which is $1,000 as calculated earlier. After buying the put option, you now have the right to sell 100 shares of Apple at the agreed strike price of $300 per share, at or before the expiration date. And let's say that at the expiration or before the expiration date, Apple really announces bad earnings and crashed afterwards to say $250 per share. In such a case, you would have profited the difference. You get to exercise your put and sell your 100 shares of Apple at $300. And if you still believe in Apple, then buy back your 100 shares at a market price of $250 each now. On the other hand, what happened if Apple did not crash after earnings, or continue to trade sideways all the way till after your date of expiration? Then your put option would have expired worthless, along with your paid premium of $1,000. If we look at what I described earlier in greater detail, and plot out the profit and loss chart of a put option buyer, this is how it would look like. As explained, your max loss is your premium paid per share and multiply by 100 shares. And this happens when the underlying stock price stays at or goes above your strike price. Now, how much must the price of Apple fall in order for you to break even? In other words, what is the break-even price point for this stock? This is calculated by taking your strike price minus off the premium per share that you have paid. And that gives you a break-even price point of $290. Meaning to say that you only profit when the price of Apple can drop below $290 per share by your expiration date of the put option. And as a put option buyer, what is the max profit that you can make from this put option? Your max profit is when Apple goes bust. The stock price falls to zero. Because when that happens, the put option that you bought still allows you to have the right to sell it at $300, even when the shares are worth nothing. But remember, the premium that you have paid earlier, it is going to eat into your profits. So your max profit is essentially the strike price minus off the premium that you have paid for it, and then multiplied by 100 shares. In this case here, our max profit will be $29,000. When you purchase a put option, you are bearish on the stock. You think that the stock price will fall in the future and then go ahead to purchase the put option. So as a put option buyer, you have to pay the premium. And as a put option buyer, you profit only when the stock price falls. And you lose if the stock price rise or even stays sideways. And this is how the P&L chart of a put option buyers looks like. Max profit when the stock goes bust and limited loss. Sounds attractive? I'll come to this at the end. Now, what about the put option seller? In order to buy a contract, there must be a seller on the other side. So naturally, things reverse. When you sell a put option contract, what it means for you is that you are now obligated to buy up the 100 shares of the underlying stock at a specific strike price at or before the expiration date. Anytime before the expiration, the put option buyer says, hey, buy up my shares at the stated price right now. If that happens, as the put option seller, you will have to buy over the 100 shares at the agreed strike price of the put option contract. No questions asked. If so, how does a put seller profit? The seller profits from collecting the premium paid by the buyer. As a buyer, you pay a total of $1,000 in premium. As a seller, you get to collect this premium. And you profit when the buyer doesn't exercise his option. This happens when the stock price stays at or rise above the strike price. And at expiration, you get to keep all the premium and the put option expires worthless. Inversely, if the stock price falls below the strike price of the contract, you would have incurred a loss. So this will then be how the P&L chart of a put option seller looks like. As a put option seller, your max profit is limited to your premium collected. And this is realized when the option expires and the underlying stock price is higher than or equal to the strike price of the sold put option. Likewise, your break-even price point for the underlying stock, Apple, will still be the same at $290. And this is also calculated by taking the strike price of the option and minus off the premium that you have collected. And that gives you $290 per share. Your max loss is when the stock goes to zero. Because even then, you will still have to purchase the worthless shares at the stipulated strike price of $300. And taking into account the premium that you have collected, if you subtract it off and then multiply by 100 shares, you would have suffered a max loss of $29,000. So if you compare the difference between a put option buyer and a seller, it is pretty straightforward. They are just in opposite of one another. As the buyer, you have the right to sell shares. And as a seller, you must buy up the shares whenever the buyer asks for it. And as a buyer, you pay for the premium. And as a seller, you collect the premium. And for the buyer, you profit when the stock price falls. And you lose if the stock price rises or stays sideways. And the opposite is true for the seller. You profit when the stock price rises or stays sideways. And you lose when the stock price falls. And this is it if we sum up everything that we have learned about call and put options so far. As a recap, you buy a call option when you are bullish on the stock, thinking that the stock price will increase in the future. And you buy a put option when you are bearish on the stock, thinking that the stock price of the stock may fall in the future. And when you sell a call option, you are either neutral or bearish on the stock, thinking that either the stock price will stay sideways or fall in the future. And lastly, when you sell a put option, you are also neutral or bearish on the stock, thinking that the stock will trade sideways again or likely increase in stock price in the near future. On the first look, it may seem like this game is rigged. The buyers get such a huge upside and limited loss, while the sellers are taking on so much risk. How is this fair? Who wants to be a seller of options then? Well, take a moment and think about it here. Have you noticed that for buyers, they only profit in one direction? Stock price must go up if you bought a call or go down if you bought a put. But let's not forget that prices can trade sideways too. So while the buyer only wins in one direction, the other two directions are favoring the sellers. In just a very crude way of putting it, the buyer has a 33% chance of winning, while the seller has 66. And this has largely got to do with time. A sideways price action when trading stocks may be frustrating, but you neither win nor lose. However, when it comes to trading options, time now works against the buyer, and it is in favor of the seller. Every day that the stock price doesn't move, you as an option buyer is losing value. And remember that I used the analogy of buying insurance to describe buying put options? What about selling put options then? They are the insurance sellers. If selling insurance is not profitable, why are there so many successful insurance companies out there? And guess what? 80% of the option contracts out there expire worthless. So don't dismiss the strategy of selling options yet. In the rest of this course, I'll be sharing with you strategies on both the buy side and the sell side. And you can see for yourself which suits your trading style best. With the basics out of the way, let us move on to the more advanced topic next. Have you ever wondered why is $10 per share the price of the options that we have used in our example? Who or what determines the price of these option contracts? Can they be like $11 or $12 or even like $5? The answer to this question lies within the Greeks, the delta, gamma, theta, vega, and the rho. A strong understanding of these will be absolutely necessary to properly trade options, and this will be fully discussed in the next video. So make sure to subscribe to the channel to receive the latest update. At the same time, click on the like button to show your support and to help me push out these videos to benefit a wider audience. Thank you, and I see you next time.